The Global Investment Strategy Group, what does it do? Has one simple job: to set the risk budget for the firm, to put into portfolios, to take account of the world as it is. We have our discussion. We take a vote, one man, one number. The average of that vote is our risk budget. End of story. We will go home, we do it again. We have these three members and myself together. We have 140 years of investment experience. That's 139 for Professor Cantor and half of it. We have a lot of investment experience, but we're only a small portion of the group. We're 17 people. So I'm going to start off with Brian and say to Brian, as a key-in question, you have been the most bullish amongst our committee consistently since the formation of the committee. I would like to thank you for that and give you an opportunity to say why, in the teeth of all these challenges, have you remained so positive?
Other than being optimistic by nature, a fault of which I'm accused sometimes, serial optimist, but also a student of monetary history, as is or was Ben Bernanke, who drew on the work, as I've done, of Milton Friedman, and his analysis of what went wrong in 1929, 1930, when in fact the Federal Reserve Bank of the US, didn't do what the system actually demanded it to do, and for which it had been established. And the role of central bankers is to alleviate a financial crisis. When there's a run on liquidity, when cash is desperately required, it is the role of central banks to feed the system with cash. And they didn't do it in 1930. Ben Bernanke actually did his thesis on that. And I was confident that he knew his duty. And he did his duty. It wasn't always easy. He did pump money in. It's called quantitative easing today, QE. It came right, as we know. It worked. And it wasn't the only crisis. There was the European bond crisis, the Greek crisis. I think the ECB, the Central Bank of Europe, had a harder time, actually, and right in the middle of the crisis, actually did the opposite of quantitative easing, actually contracted. More recently, we've had Mr. Draghi, Senor Draghi, who said, I will do what it takes, and he's certainly done what it took. So, problem opgelost. And now we're dealing with a late stage now where it's clear that we have to, at some point, reverse. Clearly it's come to the point where central banks' balance sheets, each of which is over $4 trillion dollars worth, will have to actually contract. And the contraction of those balance sheets means that the cash reserves of the banking system will also shrink.
I've got the baton from you now. I was just about to take the baton.
Right,
I'm going to,
you've got it.
Excellent. So the victory of the central banks. We had faith that the central banks were getting it right. There was a lot of controversy around, but ultimately we believed they were getting it right under the leadership of Brian and backed up by Chris. We also have a gentleman called Mr. Shaw, who's the chief economist for Investec Securities, on our team, who also was saying, you must not fight this. They will win. You must back the central bankers and winning. And the consequences of the central bankers winning is that equity risk is rewarded. That was our central judgment. And effectively what we were betting was that the outcome would be the same. Eventually central bankers would win and taking equity risk would be rewarded. Over to you, Chris. So you were the next most bullish man on the committee, and if you like, tactically you're a little more cautious now. So overall the committee has a 0 vote. We're neutral. That doesn't mean we're not taking equity risk. It means we are neutral relative to your natural benchmark. If you have a 60% equity benchmark portfolio, we are investing 60% of your money in equities. But being neutral, why are we neutral, having been more positive? Over to you, Chris.
Yeah. About a year ago, I started to soften my risk enthusiasm. And the catalyst for me, probably the single biggest catalyst, is shown on this chart behind me. Red is effectively bad, and dark green is good. As you can see, the top line, which signifies the world, the top line has become progressively more green, so that's positive. This is a purchasing manager's surveys, and it's a leading indicator that most of the central bank economists use for judging whether the mood of the world is improving or not. And as you can see down the bottom, the emerging world has been slow to recover. Europe has progressively got much stronger, as we all know, in the last 12 or 15 months. But about a year ago, it seemed to me that there was enough evidence for the central banks to start thinking about at least removing a bit of the punch bowl. And how they would do that, perhaps enlightened by how the markets reacted to the taper tantrum in 2013, when the market at that point said, we don't think the world has got enough growth for you to do anything towards reducing the stimulus or increasing interest rates in America. And the Fed backed off. But subsequently, as evidence has increased, then the Americans felt more confident they could do that. We expect to see further evidence in the next month or so that they will actually start shrinking the balance sheet, probably to start next January. Mr. Draghi is likely to say also next month that he's going to expand the balance sheet in 2018 much more slowly than he has, and he probably will spend $700 billion this year, maybe less than half that next year. So there is undoubtedly a slowing up of the punch bowl. But I think I'm in party mood. My glass is still half full. It's not half empty. That's a small distinction. I still think that there is a reasonable amount of mileage, so I'm definitely not wanting to be underweight in equities. And the main reason for that is I don't think I'm being compensated by sitting in cash, because interest rates are going to be very slow to increase, particularly in parts of the world that aren't America. So America has already raised interest rates 4 times.
Chairman's first warning.
They will probably go again in the next few months. But UK almost certainly not, with Brexit hovering, and the Europeans almost certainly not. So I think that says to me there's still plenty of scope for markets to produce positive returns. But I'm no longer as enthusiastic as I was.
And I would summarize Chris's as saying what we're worried about now is transition risk. I think a lot of people call it transition risk. Now that everything's going so well, we're going to have the beautiful stimulus of monetary policy taken away from us, and are we all going to get really frightened? And when we get really frightened, our interest rate's going to go through the roof, and is that going to damage growth, and are we back to ground zero again? And at this point, I'd like to bring in Annalise. Should we be more worried about the bond market and bonds?
Thank you, John. Well, we have seen that in the last period of time that strategist has forecast 8 of the last 4 recessions. So it's very difficult to get the timing of a recession right, and a recession is not good for markets. Markets tend to go up in an escalator, and then when it goes down, it's like jumping out of the window. So you always need bonds in your portfolio, and all bonds are not created equal. You have treasuries and corporate debt. So treasuries is your insurance vehicle. Corporate debt behaves in a bad time often like an equity. The chart we have here just shows that the last taper tantrum, the treasuries caused the sell-off in equities, and then the next month the treasuries stop falling while equities continue to fall by another 10%. So yes, even in a taper period, treasuries might scare you at first, but it is a good insurance vehicle.
So that's the case. What do you think the picture for interest rates looks like looking forward?
Many people worry about interest rates and inflation, basically because we all lived through the baby boom years when inflation moved from 4% to 14% in the US. And if you look at my chart that only started the other day in the 1300s, the red block represents actually the anomaly. So we had an anomaly of interest rates going up to 14%, and that lasted about 15 to 20 years, and we've had a bond bull market for 35 years. And now everybody says, watch out for the end of the bond bull market. However, they didn't look at when interest rates went up, which to me was the inflation bull market and then the inflation bear market. And normally after a bear market, you do not go straight back up. So my forecast is that we will go back to the norm, which is what we see from the 1300s to about the 1960s. So inflation for the near term should range between 2 and 3%, and then I think a bit later on it could go back to 4, with some spikes.
And 10-year bonds on that basis, 2 to 3 going to 4.
2 to 3. So at 2 I'll be selling, and at 3 I'll be buying.
Good. That sounds great. The only objection, therefore, that most people can give to me to make me disturbed at all is that valuation question. We've had a number of people point to the US market as being very expensive. I kind of beg to differ. And why do I beg to differ? Well, yes, the numbers look high. PE multiples do look high. They're only high because they're relative to bonds, which are very low. So when bond yields go up, however much they go up, that's going to be bad for equities. The multiple will come down. I kind of say, well, fine, I accept that bond yields are unusually low, and they will go up. But inflation is not manipulated. Inflation is a globally set variable, so we should be looking at equities against inflation if one wants to see whether intrinsically the equity prices that we are paying are inflated or not. And the answer is they're not. Even in America, which is the most expensive market in the world, what you can see is that relative to inflation, which is around 2%, then a PE multiple of between 18 and 20 is entirely consistent with history. It is the growth that you need to worry about, not the valuation.